And Peter Goodburn, really great to have you. Good to talk to you. Great to have you. There are those Peter Goodburn waves. How are you, buddy? Can you unmute? Oh, let me do it then. There. You have to click it, Peter.
Okay. Okay. Can you hear me now?
Yeah. We're live.
Okay, apologies for being a bit late. I had a Zoom update come through when I registered on to come through, and it took longer than I thought. So apologies for that.
Okay, no big deal, buddy. We're here, and it's great to have you back, Peter.
Thanks for having me. Yeah, thanks. Tell me, in your opinion, you probably saw a lot of the news yesterday about Moody's downgrade on regional banks. How does that sit with you?
Well, I've been saying that I think this is all by design for all of these banks to fail, because in order to sell CBDCs to the public, there has to be a confidence crisis and a lot of fear, and so people have to lose trust in the banking system, and maybe even go through limited withdrawals, which I think they're already doing in Australia, because you're not going to sell a central bank digital currency. It doesn't even come from the treasury, just because, like in COVID, it could carry the virus and other diseases. The cash is dirty. Okay, they're going to need more than cash is dirty to get people to convert. Usually it takes a lot of fear and belief that the new thing will be better and fix things. That's my view.
Yeah, no, I recognize that. I mean, this whole idea of digital currency is just a prelude to control, social control. And you know, we've been discussing that in-house here quite a bit over the last 12 months. Well, even longer, obviously, the pre-run of COVID. But it's basically a small fraction of what's undergoing in the sort of the manipulative world of politics these days. Unfortunately, there's so much corruption going on that we're heading down into a bit of a black hole, and I'm not sure exactly where it's going to end. I think I'm a born optimist, so basically I always think that we're going to find a solution to prevent sort of the industrial complex from taking over completely control and using us as beings of social credit systems and stuff like that. But I'm hoping that the financial system will survive in some form later. But I think we're probably about 3 years away from an implosion of some sort. And this comes down to
because you think that when this sell-off that may be beginning completes, that would be the end of wave 4, and that there's still a 5 to come. And it's hard to see financial big failures unless that's what generates it, and that the dollar is a sacrificial lamb, and that's how they get the market to recover from lower levels. So I mean, we could start with the dollar here, Peter. Looks like you short term looks like, you know, this 285 level is important, and we're going to get a chance to buy the dollar around what, par and a half or so, where that big spike low happened a few weeks ago.
Yes, I mean, I think first of all, I mean, talking about the dollar, I mean, we're actually in the bigger picture. We're talking about a dollar demise of about a 50% sort of devaluation, and
well,
and
that's how we get to CBDCs.
Well, that's it. Yeah, and you know, this is part of the makeup. I mean, obviously, before we start getting sort of social credit systems and things like that, where the control comes, we're going to have the final phase of the inflation pop, which is a theme I've been talking about since 2010, actually.
Yes.
And where commodity prices, the commodity super cycle actually stopped, well, basically ended in 2006, 2008, just before the financial crisis. And commodities are going through a sort of inflation pop, which is part of the inflation, the real inflation that you're seeing in the last 12, 18 months emerge as well. It's all part of it. We started with an asset price inflation, and then we go through into food and energy and inflation of that kind in the last 12, 18 months. But that's still bubbling along, and we've got the inflation pot still running through until about a couple of years' time, and then the bubble bursts, and that's when we're going to get this whole digitalized currency and social sort of credit system coming through, which is a level of control. I'm hoping that we can avert that. In some case, humanity is going to have to get itself into action before then, in some form of overture, which will basically eliminate that risk. But
I mean, what can you do? Is there really any way to prepare? I guess people who buy Bitcoin believe that they're preparing for something like that.
I don't think Bitcoin's the answer. And I think some years ago, when Bitcoin was still in its early phases, I talked about the fact that Bitcoin would eventually come under similar controls as the Gold Act of 1933.
Okay, it'll make it illegal?
Make it illegal, or it will come under a surveillance of control anyway, which is what you're seeing with the SEC at the moment.
You mean with the new ETFs are a way for them to surveil?
I think the ETFs is basically a way for them to appease the push against their digitalized currencies.
I see.
It sort of legalizes it to some extent, and so you can trade ETFs in Bitcoin or whatever. So it sort of takes away that stigma that it's a banned process of financial play. But so they're trying to appease it that way. It's a bit of a smoke screen, really. But ultimately, it's a level of control. The problem is that if you've got a digitalized currency like that, what happens if you turn off the internet?
Yeah.
Or you do what China can do, which is control the internet and certain platforms. As soon as
you have to show your ID at bridges and traffic stops, and you never know when you show it if you're going to be allowed or not allowed to do something.
Or you have an app on your phone which is a swipe.
Yeah, right.
Where you can't get internet connection unless you swipe first or whatever.
Right.
I mean, things like that.
Yeah.
I mean, we're talking about some strange stuff now, and we're
Very
not talking
dystopian,
about markets. Yeah, sorry, I wasn't really prepared to talk about things like that today, because these are really hot subjects, and we do talk about them to our institutional clients, and it pops up more frequently than you'd like to think it would. But we do know we're on a sort of a time limit here, and ultimately, and maybe I'll show you what the dollar looks like on a very long-term basis, and then we flip back to the short term. But
I think you have like targets in the mid-50s or something before it's over. Do you think this new currency, Peter, that the BRICS are coming out with and launching, China launching the 22nd, is going to have any impact in the currency markets?
Difficult to tell, isn't it, really?
Yeah.
Difficult to tell at the first stage. The markets are really sort of work on perception.
48.
They work on a lot of perception. Well, I'm just going to show you the dollar index over a very long term. This is going back to 1660s.
Wow.
There's some really nice Elliott wave patterning and proportional relationships in here. We go back, really, the most important point was really this low in the American Civil War period, so 1863-4, and then you go up in 5 waves to 1985. And so actually people are being basically mindset into thinking that the dollar's a strong currency all the time, but actually it's been weakening since 1985, dropping down like this. And we actually, in September, when we were at 114.78, we actually ended up here at 114.78. We've ended up completing a big running flat pattern that goes back to 1987. And we're getting ready for wave C declines. So we've just do a normal 61.8 or 38% extension in this case, of the initial swing down, and we arrive at 51. So we're going to halve in value, and that's basically means a doubling in the euro dollar as well to the upside.
Okay.
So this is a very long-term
euro
perspective.
Okay.
Yeah, the euro dollar would double, go up to sort of like $2 to €1.
Is that going to be the best performing fiat, or will Aussie be?
Good question. Well, the Aussie dollar on the very long term looks a bit like this. Let's have a look at the. That's a quarterly.
Because isn't the Aussie getting closer to your targets on the downside, and it's been the weakness? That's a pretty good move from 60 to, that's a triple.
Almost. Yeah, so that would outperform. Yeah, so that would outperform. Yeah. I mean, this is not so dissimilar to the idea of the inflation pop in commodities. Right. So copper and particularly crude oil. I think crude oil can go to $200 a barrel easily, maybe a bit more. So this is basically in tune with that. We've, I mean, people obviously look at, in the commodity sphere, you look at sort of Australia, and then you start thinking about iron ore. But sort of the long-term iron ore prices probably not going to do something fantastical. I mean, yes, we've got a very long-term iron ore chart here, which is going back to 1900. But you can see that we've got a target of about $360 a ton. Wow. So yeah, that could be, I suppose that could be tripling in that case. So coming back to the Aussie dollar, yeah, it would be an outperforming fiat currency if that's what we've got, and copper prices will go up a lot as well. So these commodities have got a lot to do, but not right now, because
so we're coming near inflection points and everything. You believe we've reached an inflection point in the indices?
Well, I do think so, because here's a chart on the S&P, which is going to go in tonight's report, which is the for those of you tuning in, if you haven't already taken an idea or look at the Elliott Wave Compass report. We publish this twice a week, and this is going in tonight's report. Actually, I'm just staring at this at the moment, wondering if the Eurostoxx 50 and the Xetra DAX has just started to turn down. They've met sort of like minimum upside objectives, and they look quite weak. So I'm not sure if the S&P is actually right now going to get up to my target, which I had last Friday, which was 45.60. It's an attempt back to wave 4 proceeding. But the important thing here is that the bigger decline is coming, because we've had now a 5-wave drop into last Friday's low. If you remember, last Friday we had that sell-off
in the last half hour, right?
Yes, and that produced a 5-wave.
When everyone's away.
Yeah, everybody's sort of shut shop and going home for the weekend.
Yeah.
And then there's a late sell-off, and it's sort of changed.
It's in your face if you sold that close on Monday.
Well, that's right. I mean, we did mention that that did leave a diagonal pattern, a 5-wave diagonal in that extra swing down. Yeah. And you can see it also in the Dow. Let's have a quick look at the Dow as well, the Dow futures. This is, you can see that the extra swing down on Friday night produced this diagonal pattern, and we've got some sort of expanding flat going on in there. And the problem with markets like this is that, well, you can see that wave A has already gone back to wave 4 proceeding, and sometimes wave C will end up as a running flat. In other words, it doesn't quite make the targets that it would do under the normal conditions of an expanding flat, and wave C is therefore a little bit short. And I'm getting a little bit concerned looking at the screens at the moment that we may be involved in something like that, and the markets are getting ready to tilt to the downside straight away from current levels, because it's all looking a little bit fragile. And my main let's go back to the
what
S&P.
I'm trying to square, Peter, and is there's going to be a period, if this count manifests and your count in the dollar manifests, that people are really going to be off sides, because people would expect the dollar to do a whole lot better than just a bear market rally to 108 with this kind of risk off happening. So a lot of the decline is going to happen with a weakening dollar.
Well, it could be, yes. I mean, that is a very good question, because, we initially recently diluted the upswing, because we originally thought, well, okay, we're going from 99.5, and we actually thought that it might trade up to the 76% retracement level, which is about 111 something.
Right.
So we looked at that. We're recently sort of doing a lot of currency work for our trilogy series, which comes about mid-year, and we're finishing off at the moment this week. And when we did a lot of cross-currency relationships, we found that it might be a bit too ambitious for the dollar index to get to 111. So we thought that maybe we might have to do with getting to the 61.8 area at 109.14. But yes,
there's going to be a period where people are probably going to be saying, well, look, the dollar is weakening. How come we're not seeing risk on? I mean, that's down the road, but yeah, I'm just saying that it doesn't look like, for the magnitude of decline, unless it's just shows how weak the dollar is, that you could have a magnitude decline of what you're looking for in S&Ps. And only,
well, that brings me to an interesting
108
subject about dollar yen, because dollar yen is a fascinating one for me, because when we were
I've been trying to short it all week. It's in my face every day.
Yeah, well, I think the in terms of dollar yen, we had,
it's at 78.6 back now. If this is a 2 up here, 44.
Yeah, it's getting quite deep, and it might even take out 143.89 slightly, but I don't think it's going to break 145 figure, this 07 number, because that preceding upswing from January here, 127.22, was a really nice. If I just put my Fibonacci extension ratios in, you'll see if I extend. This is a typical measurement, by the way, for everybody listening in, for a zigzag. If you extend wave A like this, if I'm double clicking, I'm going to extend that by 61.8, and you'll see that it came within about 7 pips of the top there, and
nice call.
Which was good. Yeah, it was nice. And now we've had 5 waves down to 137.24, and we've had a nice what looks to be a 3-wave action up, which I think probably is a double zigzag actually, but it's got to 143.89. That's the 38% extension level of this initial swing up last week. Now, you might think, well, okay, look, if the dollar is trending up to sort of 109, 111, let's say, over the next several months, and we have that sort of going dollar bid because of safe haven, it's attracting safe haven status, then why should dollar yen drop? Well, I think
that's a safe haven currency too.
But I think, yes, exactly, because I think the yen, which is basically being used as a funding currency for the last 2 years, is suddenly going to flip, and it's going to become a safer haven than the dollar.
Interesting.
It's going to become a safer haven for the dollar. Well, how do we substantiate that? Well, okay, we can go through the mechanism here, which I've just explained, 5 waves down to 127, and this 3-wave rally to 145. Okay, that's a normal function of Elliott wave. That should mean that we encounter a downtrend, probably sort of looking something like this, where the dollar yen starts to accelerate down like this now. But we need to verify that. What does it look like against, say, something like, what does the yen look like against the euro? So if you take a look at the euro-yen chart, we see something pretty interesting on the weekly. Because if we go back to 2016, which is this low here, so this is 105.55, you'll see that we've got a really nice zigzag finishing. So again, we can extend this by 61.8 and derive where we are at the moment. And this, I mean, it could squeeze out a tiny bit more to 161 if we extend the preceding downswing by a 23% ratio like this. We get to that 161.25 area, so it could squeeze out a tiny bit more. But basically, this is on a very short fuse now, because it means that this big upswing is about to complete, and it's wave B of an expanding flat. So it's basically intermediate wave 2 in brackets here, which is an expanding flat, and wave C is going to drop down in the next few years. So the initial stage of yen strength is going to be all about a safer haven here. Okay. This drop down to 136 is all about the next several months, a decline, about yen being a safer haven than say the dollar.
Interesting.
And so therefore you're going to see, because of that, you're probably going to see a slight dilution in the dollar index's rally up to 109, 111. You know, it's not going to break the 114.78 high
because of the yen.
Because of the yen, and also because of the Swiss franc as well. Because if you look at dollar Swiss, I'll see if I can find that quickly. If you take a look at the dollar Swiss franc over a weekly chart, sorry, this is trending down in a big way.
Yeah.
This is trending down in a big way. The
Just
Swiss
had
franc,
a big breakdown. Yeah.
Yeah. So you've got two G10 currencies within the dollar index itself, which are going to be a stronger, safer haven than the dollar itself. So there's going to be a weakening on that slightly. It's going to be a slight dilution for the dollar index itself. The weakest currencies, I think, are probably going to be the Canadian dollar. I've been shorting that against buying the dollar itself. So I think that Canadian dollar will probably end up trading up to 140.40. And you can see it's already pushing up. Yeah. This is a nice double zigzag correction from October. So this is trending up to 140.40. And it's just a question then, I'm hoping that the Aussie dollar doesn't break down too much, because I think
that we're going to put in a higher low.
Well, I think this upswing is 5 waves, which should eliminate the possibility of it breaking below there, but it's going to be a bit of a tight call. I'm not sure what's going to happen there. But I'm more confident about shorting the Canadian dollar at the moment, because I think
will the Hong Kong dollar break the peg?
Oh my God!
How long have we been talking? How long has the market been talking about it?
Well, you know, I was living in Hong Kong 25 years ago for a while, and I stopped looking at the Hong Kong dollar peg then, because it wasn't really doing much. You know, it's not really an exciting place to be trading. And it's a bit like waiting for yield curve control in Japan to be lifted, so that you can make money by shorting the JGB futures. I mean, I've got clients who are doing that, but quite honestly, it's like waiting for paint drying, isn't it? I mean, in a sort of a winter environment. I mean, there's a lot of other exciting things to get involved in.
Yeah, like watching paint dry.
That's more exciting than the dollar peg being dissolved in Hong Kong.
Why don't we wrap it with, I know you brought me a present. I know you brought me an Apple chart today.
Oh, well, yeah. I mean, I have been updating some of these components, the big tech components.
You've been commiserating with me from afar. And I know you have a count here.
Yeah, here it is.
Okay.
Yeah, I mean, look at this Apple drop now. From
I mean, when the market starts off like that, Peter, isn't that a pretty, like, you know, I mean, it gapped the 50-day on that day after earnings. So it doesn't look broken to you now? It
does look broken. I mean, we had this double zigzag down here to 124, but I thought that extending this by 61.8 would have been enough to revisit the high.
Well, everything's stretched. I mean, what was your self-talk when the S&P kept stretching?
Yeah, I mean, it has stretched and continued to stretch.
Yeah.
The most important thing, I think, with the S&P is that we didn't break above the Jan 22 highs. Yeah. And we're now getting a nice reversal signature in the form of that diagonal we looked at earlier. But these
before I just want to say, looking at this Apple chart, I just want to remind all our listeners about this. One bad apple don't spoil the whole bunch, girl. Donny Osmond.
Good God. Did he? Yeah. That's going back a while. I wouldn't have remembered that one from Donny Osmond. But No, there's a lot of these big tech stocks which are turning down. One of the ones I keep getting asked about is Tesla, and on Tesla you can see that we had a really nice three-wave advance from last year's lows, or from January's lows up here. I think that's finished and we're heading down as well. A lot of these big techs have run their course now.
But a lot of them aren't going to make new lows, aren't going to take out their October lows, are there?
No, they won't. No, I mean, yes, Apple should, but this one won't. But you can see the percentages. If you work out the percentage declines, they're all about 35–40% drop, maybe some more in some cases. So if you look at the individual patterns, you'll see that it's the same with something like I think we've got Facebook, Google here. You can see that won't break it. That won't break below the November's lows. But you got this big 5-wave advance, and as a 5th wave, it's pretty stretched. You know, that's we don't normally extend a 3rd wave by 61.8, but we've had to do it in this case.
So what led this rally are going to be the ones you're going to want to buy year end.
Eventually, yeah, absolutely.
Yeah, could be year end.
Yeah, but I think it will probably. It's either year end or 1st quarter sometime, depending on how fast we go. But I think these are going to be unwound pretty dramatically. And I think that the market's going to be pretty surprised. They're still lingering near the highs, as you can see here. But a lot of these tech stocks, these big tech stocks, which are the components of the FANGs index, the FANGs Plus index, are going to be hit pretty hard, I think.
Isn't it interesting they wanted to rebalance Apple before the high? So it wouldn't have the same impact on the NASDAQ 100?
Yeah, I mean, there's always that manipulation going on, and we've seen it before. It really mucks up my charts, I have to say. We have to rewrite them all through several different time frames.
So, Peter, the narrative's going to be now after this run, people are going to buy every dip. They want to buy a dip to 4,200. That's where the breakout is, all the way down to 3,900. How are you going to know that this break, when we get this break, is going to have legs and not just be a corrective decline?
Well, I mean, the short answer to that is quite simple. From an Elliott perspective, we'll be looking at checking to see, first of all, 5-wave development to the downside in every case.
Right.
So we'll be going through, we do routine checks. I mean, we'll be extending this diagonal by 61.8 because and if we get below that, for example, that number, and you start getting price expansion, then you're not in a C wave of a zigzag, but in a 3rd wave. So we'll be doing something like this.
We get 1, 2, 1, 2s.
We'll just extend that by 61.8. So if we start getting beyond levels like 43.92, you know that you're in a 3rd wave acceleration point, which would be consistent with what we'd expect down here. And we've also, got some preliminary targets. I mean, our big target is a 61.8 extension of this at 28.79. And if you cut 46.34 to 28.79 by 61.8, you'll get this number and this number. And so we've got interval numbers where we're looking at sort of some harmonics coming in. And if we deviate from that and you've only got 3-wave patterns, then you might raise an alarm signal. But I'm pretty confident that we're going to see a realization of this larger decline because we've got so many different sectors which have underperformed the S&P, which are limping up from last October into clearly defined zigzag patterns, which are rolling over to the downside. And also we've got the banks, as you saw Moody's from their downgrade. The banks index, the KBW, looks very, very bearish. We've been running up actually nicely since May's lows into corrective patterns, but we're finishing those now. So, things are beginning to look as if we're going to get a commercial real estate problem.
Citibank never rallied with the rest of the banks, and looks like it's on the verge of a breakdown.
Okay, I haven't seen Citibank, but I do know that the banks index itself is fast approaching its upside targets that we had in May, and they're all turning around. Plus, together with some of the regional banks that we did actually put in our mid-year report, which is still available, by the way.
Speaking about reports, I read Peter's stuff. It's excellent. And what's the best way that people could get a hold of you? You want to show your website, Peter? And what a great discussion on currencies and thinking about the Swiss and the yen in face of dollar rally, how they could perform, which most people wouldn't think could happen. In fact, I did an interview, and one of the comments was, how could Dale be bullish a dollar and bearish US dollar yen? Doesn't make sense. And
well, hopefully that's answered today with looking at the cross rates. I mean, you can also have a quick look at sterling yen. From 2016, there's a big 5-wave pattern completing up from 2016. So have a look at that if you're still unconvinced, and just look at some of the cross rates with the yen. You'll come to some conclusions like I have, that the yen's going to be a very strong currency. How do you participate in what we're doing here? Well, we'd be excited to welcome you to the Elliott Wave Compass report. You can go to wavetrack.com, and if you go to products and where do we go? Subscriptions. Sorry, registration and subscriptions. Go to subscription, and the first subscription tab is here for the Elliott Wave Compass report. Is $39 a month, but we're going to send you a couple of reports per week in a PDF format, and you'll also be able to log in online to look at all the charts there as well, with some other features. So yeah, that would be great. If
would they get your mid-year updates and commodities and that you publish?
Well, we've got those available. They're over here. If you go to the main page again, you can see the mid-year reports are pretty much available. Well, the stock indices was published in June, and the commodities in July. These things actually are really big heavyweights reports. There's 2.5-hour videos accompanying those.
Wow.
And there's over 100 or more charts in each. I think the currencies and interest rates ones, which we're going to publish within the next 4 or 5 days, has got over 150 charts of currencies and interest rates in there. And the video is, I think I may have even done a record 3-hour video. But keep a lookout for those. And if you want details of how to purchase those, you can just go into the main website and click on these, and it will take you to actually our blog. And there's a summary of what's included and some details at the very bottom, which would tell you about how to subscribe to those. So yeah, take a look if you're interested in those. It's very informative, and I think people have already raved at they're very complex, but also at the same time they're extremely informative. So yeah, that would be a great place to go.
Okay, Peter. Ingmar is saying thanks. Great interview.
Thanks, Ingmar.
I agree. And this summer, may you have health and prosperity, my trading warrior brother, and really enjoy talking to you.
Well, as always, Dale, thanks. Yeah. Thanks for inviting me on. Thanks to the boys for also, allowing me to sort of present some things today. And I just really hope that you too, you have a great summer over there, and try and find some rest and relaxation in between, because these markets are going to keep us busy. You know that.
Yeah, we still have to fight the battles into, the dystopian future. I love you, my trading warrior brother.
Thanks, Peter Goodburn. I love you too.
And Peter Goodburn, you're very welcome, Peter. Check him out. You're welcome, Salim. Could join the team in 4 minutes on the morning edge. Don't just count your pips, count your blessings. See everyone for the number tomorrow. Adios. Thanks, Peter.
All the best, Tom.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.